Great. Hello, everyone. Good morning.
Good morning.
Hello, hello.
Well, good evening.
Or good evening.
Afternoon to the
Good afternoon.
probably many people in the Australian time zone who are joining this call.
Good morning, good afternoon. Great. So we can get started, and then as people join, we'll just be letting them in. So welcome to Catalyzing Change Week, day 3. Today, we will have Tom, Cameron, and Karen presenting Bridging the Missing Middle, Funding Pathways to Scale Impact and Innovations. Amazing, amazing. We're just going to do some quick introductions, some housekeeping, and then I will turn it over to them, and the floor is theirs. So we just have a quick video. Let me make sure that I am sharing with my sound.
An estimate by the IMF states that AI can raise the world economic growth up to 0.8% or contribute approximately 15.7 trillion US dollars by 2030 to the global economy. On the flip side, over 30 million jobs may need to be reconsidered over the next 5 years. Across the sessions, you will hear from technologists pushing the boundaries of what it is possible, entrepreneurs and educators rethinking the future of work, and faith leaders reminding us that progress must be grounded in compassion, justice, and dignity. These conversations go beyond tools and systems that ask bigger questions. How do we ensure technology serves humanity? How do we design economies that are fair, inclusive, and ready for the future? And how can values guide innovation towards a more just and sustainable world? This is a space to share insights, challenge assumptions, and collaborate on solutions of change. Welcome to these sessions presented by Catalyst Now.
Great. Okay. So just some housekeeping. We ask you to please keep your video on, show your name, your company, so everyone knows who you are. Obviously, unmute to speak. And if you have any problems, feel free to reach out to me. And most importantly, do enjoy. And for those of you that are joining us that are not yet Catalyst Now members, I will send the link in the chat, and we do please invite you to join our movement. Yeah, that's all. All right. So Tom, I'm going to turn it over to you. Go right ahead. I'll stop sharing. Over to you.
Fantastic. Hi, everyone. Thanks so much for coming to this session. My name's Tom. I'm the co-founder and chief impact officer of Lend for Good, which is a new impact lending platform that is trying to make a contribution to this endemic problem of the missing middle in impact capital. I just want to acknowledge that I am hosting this call from the traditional lands of the Camaragal people of the Eora Nation here on the North Shore of Sydney, and pay my respects to their elders past, present, and emerging, as well as my respects to the traditions contained in the land that each of you are joining us from and your own personal stories and traditions. Before we get into the conversation, I'm really delighted to have two fantastic guests joining me for this conversation, as well as all of you, and we definitely want to open it up and hear not only your questions, but your contributions on these topics as well. And so I'll be introducing Cameron Burgess and Karen Monaghan a little later to join the conversation, but before I do, I'm going to give a bit of a scene-setting presentation around, I guess, some of the ideas and explorations we went through as we were thinking about this challenge and how to solve it over the last 7 years, which some of the ideas of which kind of emerged into what became Lend for Good. And it's not a coincidence Lend for Good was co-founded by two existing social enterprise intermediaries, Start Some Good, the crowdfunding platform I and Renata, our CTO, had previously co-founded, and Red Hat Impact, who were kind of active debt facilitators, I guess you would say, who were in both cases trying to respond to some of these challenges that we saw. When I started Start Some Good 15 years ago, the gap that I perceived was at the very beginning. I was in San Francisco at the time, and I felt like that was the first time I'd kind of experienced what a pro-innovation ecosystem looked and felt like. And the particular piece that I was intrigued by and inspired by was the idea that people were willing to provide you support at the very beginning when nothing was yet proven. And that just felt so different from what I'd experienced working in philanthropy through my 20s, social impact, but with most funds raising money from philanthropy through my 20s in Australia, where it felt like there was significant money out there, but only for things already proven to work. And that, of course, made innovation and technology in particular challenging, because it wasn't just that we hadn't done many of the things we wanted to do. No one had done them, and therefore we weren't sure if they work. We thought they were worth trying. So, having done that for 15 years and worked with hundreds of social impact organizations, it became increasingly clear to me that the bigger gap was no longer at the very beginning. There's a lot more support at the very beginning now than there used to be. I think there could still be more, but there's, startup programs out there. Every university in Australia and in many parts of the world has programs to support student entrepreneurs, etc. And the gap is now this stage further along. So let me just quickly share my screen. I'm going to run through a few slides as I just talk to this. Hopefully this is, someone could just give me a thumbs up to confirm that this is on your screen. Excellent. Bridging the missing middle. So often when people are introducing, and did that change just quickly? Because sometimes I get stuck on the first one. Has it moved on to a new spectrum of social and financial investment objectives? Great. Normally when people present to people about impact investing, they present something like this, different ways of representing it. But what I see a lot of is when people are speaking at either investing conferences or perhaps social enterprise conferences or social change conference, and they're like, let me explain impact investing to you. They place it along this particular continuum, which is a spectrum of social and financial investment objectives. And that is, of course, one really important continuum. And you can break it down in different ways, but in this particular example, over on the left, you have just normal investing, normal profit maximizing investing. On the far right, you have traditional philanthropic donations. Obviously, they are for impact, but with no expectation of return. And then you have a few gradients in between. Venture philanthropy, second to the right, is not so much a different type of capital, but a different mindset. It's still philanthropy, but done through the lens of investing. So with an expectation that, with the help of these funds, you might be able to then stand on your own 2 feet and not require more philanthropy ongoing. Over on the left, we have financial first, which is to say they want impact, but through the lens of commercial investing. And so still with the same expectations and requirements in terms of returns as traditional investment, but also impact. And then there's this two in the middle, impact investing, impact first, which, to be honest, I find it a little bit hard to differentiate what they mean in terms of those two, but essentially where you'd expect both of those to be versions of return adjusted investment, a different balance of that social and financial investment objectives. But there's a couple of things wrong with just explaining impact investment along this continuum. The first thing is that it doesn't tell you what's really happening. Because what I tend to see is people explain this and all the social entrepreneurs in the room go, fantastic, I want that impact first one. That's the one for me. And they kind of identify of these flavors, which one would you like? Hey, clearly I want the one that's, in fact, even venture philanthropy might even be better. It doesn't tell them what's really happening in the marketplace. And these things are not at all equal. What we have in the marketplace is still a lot of philanthropic in various places, not necessarily for social enterprises, but the totality of philanthropy is very large globally and growing. We have precious little venture philanthropy, philanthropy genuinely done with the risks and kind of innovation profile of startup investing, but there is some, and I welcome it. And then we have lots of finance first impact investing and very little of these other flavors that most social entrepreneurs like the sound of much more. They're adjusted. The other thing this doesn't tell you is the other dimensions that go into investing. So the one that was obvious to me when we started on this Lend for Good journey was risk. And I thought a big part of why we don't get these more money at an earlier stage was that things were simply too risky for people. And that is another important dimension to think about, people's risk tolerance, even at any of these stages. Are they willing to back new things? Are they comfortable with the, risk return trade-offs, failure rates, and so on of supporting genuine innovation? There's not enough of that across any of those. But the other that I had not at all appreciated enough 7 years ago when I started exploring this through the Lend for Good frame was scale, was just the size of investments. And that most impact investors, again, regardless of flavor, are looking for bigger deals because they're more efficient for the investor. And so that's what leads to this mismatch in the ecosystem between the supply of capital and the demand for capital. A huge demand at the earlier stages for that capital and a significant supply at the latter stages. This shows them overlapping, but we prefer to visualize it more like this: a bridge, a well-built bridge, but with a significant chunk out of the middle, because the two sides are largely not intersecting at all. Our previous graph was a maybe slightly more sophisticated way of looking at it. Thank you, Unicenter, Griffith University. But it does imply that there's significant overlap between them. While there is a mismatch, too much of each at either end. But actually, they sit almost entirely in different parts of the ecosystem, and far too few companies are making it across. And so this missing middle means that the two centers of gravity in the impact business kind of world, in a way, which is fantastic startups, the people that I've been working with for the last 15 years with my Starts and Good hat on, have completely convinced me that we've already got the solutions for pretty much everything. But what we mostly lack is that we haven't scaled them up effectively. But they're out there. There's brilliant people working on every challenge, trying out new ways of solving it. And through that, through trying all that stuff out, there are great enterprises with real solutions for the community, and which are scalable in the sense that they will be sustainable and profitable and be able to pay a return to investors. I certainly believe. Meanwhile, we have the impact investment funds, which is the vast majority of what constitutes impact investment in the ecosystem. And they have literally trillions of dollars to invest. GIN, the Global Impact Investment Network, reported last year a new record for funds kind of invested in impact investing of 1.5 trillion last year. I should have put that number higher, because actually what they also said is that there's now over $3 trillion in those funds. So the money is literally banking up in those latter stage funds. People are investing in impact investing, but they're not investing in impact enough. And so what that means is, despite the ecosystem having everything we need, you'd think, to look at it, we've got the solutions, we've got the capital. Almost no one in the ecosystem is able to get what they need. The founders can't, and enterprises can't find the right capital at the right stage. And the impact investors can't find the deal flow that they need that meets their particular mandates in terms of commercial and social impact. And so part of that is expectation and what people are looking for. What most enterprises are looking for, and what many of them think impact investing is, when they visualize it and think about what is impact investing, they think it looks like this, which is that there's firmness around the impacts. If you imagine impact, more impact is up, more financial return is to the right. They imagine that there's, the impact investment sector might have a range of return requirements, but is relatively firm on the impacts. Obviously, that's what it's there for. So there's a decent threshold there, but a greater flexibility on returns. But in fact, the impact investment sector is largely in the opposite direction. So most professional impact investors are quite firm on returns, and financials have often been given very traditional a mandate that they have to make the same returns as their non-impact brethren, or what's considered risk-adjusted commercial returns. And they have various degrees of specificity around how much impact is enough. And actually, the best of them, in the sense of being the least greenwashy, the most specific, the most committed to impact, are actually in many ways the hardest to deal with, because that puts them just a little box up the top there. Very high on impact requirements and very high, but still the same kind of expectations as in terms of commercial returns. Now, the challenge of that should be probably intuitive to many of us, but is worth saying out loud, is that it's very hard to be equally profitable as extractive business. That we're trying to reinvent the whole act of social enterprise is in a way to rethink the balance of rewards in business between private returns to capital and ownership versus returns to community, environment, future generations, workers, other community stakeholders. Equally, again, those impact investors who often usually want a commercial return, they also want to be reassured that real impact is happening. So they also want you to do really good impact measurement. But again, you have to, so that's an entirely additional cost center. So in some ways they require you to be more commercially efficient than non-impact businesses, because in addition to being able to throw off the same level of return on capital, you also have to provide sophisticated impact measurement, which of course has a cost, but one that they don't want to bear. And so what we see here in a way is a classic system challenge, that people are saying they want a different outcome, but we're not getting that outcome. Why is that? Because of the things but beneath the water here, because of the pattern structures and mental models that go into investing, and that we've ported across from traditional investing into impact investing. And so the pattern we see is the missing middle. That's the key kind of pattern in the impact investment marketplace right now. And so why is that created? Well, we think it's about those next two layers. It's about the vehicles, the structures and processes we're using to do impact investing, and it's about the mental models that we're using to think about investing. So many of which are so deeply held in the investment world that they don't realize that they're mental models. I don't know how many of you have had I've certainly had the experience many times of hearing people talk about concepts like investability, for instance, as if it was a concept out there, as if they were describing gravity, just a thing that was completely a thing that, a fact of the world that you just had to work with. But of course, investability is something we get to decide for ourselves in terms of how much return we consider to be sufficient to be worth investing. So at the moment, most impact deals in the ecosystem, and why they're so hard to access for so many enterprises with different models and at different stages, particularly those that are earlier in emerging markets, run by First Nations or female founders, or anyone who really doesn't fit the mold of traditional VC investable businesses, is that they're expensive. There's a level of due diligence done in impact investing that is greater than that done in non-impact investing, meaning the cost structure for those investments, and this is the bit I didn't understand, the structure of just the vehicle that is doing the investment sets so many of what's possible. If you're going to spend $50,000 on due diligence, you can't do $100,000 deals. They have to be at a size that can absorb what you're spending on your decision making. And then it's not just, of course, that you have to absorb the cost of your due diligence. I spoke to a serious VC recently, and they told me they did 100 full due diligence processes per investment. So if you're trying to raise money from them, you don't have to just cover your own due diligence process. You have to be able to cover 100 of them while still providing commercial returns and covering, of course, the profit margin for that investment manager as well, all of which is done by some of the highest paid people on earth in the financial sector. So it's extremely expensive. There's incredibly expensive decision making. Therefore, they have to be large. It's that requirement, not the risk, that is why so many good deals don't get done, I realized. But there's these really, to me, very obvious low-risk deals, people who have more demand than they can manage, and now they just need to buy a piece of equipment which will increase their costs of goods sold and increase their scalability. It's like a complete no-brainer, pays for itself in 6 months. But they only need $100,000. The problem is no one's even willing to look at that deal in the ecosystem. It's not that it's too risky or won't provide a sufficient, or even that it won't provide a commercial return. It just won't provide a commercial return plus cover the costs of due diligence that people need to do. So they need to be large. They're inevitably investor first. No matter what someone sets out to do by setting up an impact fund, they end up having to make commitments to investors in order to have anything in the fund to then invest. And so unavoidably, all funds are organized around investors. They're a promise to investors, which then shapes a particular opportunity, and they have to go looking for enterprises that can fill that opportunity space in terms of their scale, returns, risk profile. They're mostly seeking traditional returns at the moment. As I said, they tend to be siloed by thematic. There's many impact funds that are not really very themed at all, other than impact investing as a theme, which sounds like a logical thing to do if you're not really that focused on impact. But of course, if you really care about impact, you care about particular impacts. And so if you think about, imagine if you had to do philanthropy the way we do impact investing, that you had to give your money to like Good Things Australia, Good Things Pacific, but which would then deploy your money in some sort of good thing, but without you knowing what particular good things were being supported up front. That many fewer people would do philanthropy that way, because people want to know what it is they're giving their money to. The good deals are hard to find and inaccessible, particularly at that early stage. And so we kind of looked at that problem, and the thing that we thought a lot about was, and what we'll talk about today in terms of innovations, I think most of them are about overcoming some part of that puzzle. How to make deal flow and due diligence less expensive. how to break down or aggregate, sometimes it's about aggregating, so it creates a larger deal, but within it has smaller pieces, but how to kind of get earlier stage via smaller deals which is where, the greatest need is. Not just in the impact investment sector, but the SME sector globally is suffering from this. As banks have merged and got bigger, they also are just generally interested in doing less smaller lending. And it's a huge problem for the entire SME sector globally, with or without the impact lens. How do we build different kinds of mandates and bring different people in who are not as fixated on traditional returns? One of the ways we really believe, and from my background in crowdfunding, is you let other people do it. I think one of the limitations is that we spent the last 10, 15 years in impact investing trying to convince investors to do impact. And the best most of them have done is just added it as a thing on top. They're still going to do everything they know how to do and not question any of those traditional processes, those commercial returns, which are of course templated based on a commercial system we don't like and supposedly are trying to build an alternative to, but somehow are meant to maintain all the norms of traditional returns to capital. How do we instead let people who care about impact do investment? And of course, what we see is through crowdfunding mechanisms, people will do investment, but they don't even know. And this is not about taking advantage of people's ignorance. They're just less fixated on this number that is commercial returns on investment. They don't know what traditional commercial returns. They don't know what traditional valuations are. They just look at it. They look at it in front of their eyes and decide if it feels right for them. So they're able to tap into other human ways of knowing as well. The other thing I didn't say there is, of course, traditional investing has to work on a spreadsheet. And this again is why the traditional finance sector is struggling to value impact, because we still don't agree on how to put that on a spreadsheet, and I don't believe we ever will. I feel like that's actually an unachievable goal, and people who tell you they do impact investing, if only there was better impact measurements, I think that's an excuse, because we'll never be able to capture all the things that matter most in terms of human lives and future possibilities in spreadsheets. But if you're investing other people's money, you have to kind of show them why you did it. And that means has to fit on a spreadsheet. But if you're making decisions for yourself, you're able to use other human ways of knowing. And so think about, the way impact investing to me should be more like how you buy a home and less like investing in a property trust. At the moment, it's like investing in a property trust, just an asset class with experts in charge doing things that make sense on spreadsheets, which is fine if all you're looking to do is maximize your financial returns. But if you want to maximize impact, think about instead buying a home. Of course, you also want that to be a good investment. It's fine to want it to be a good investment, but it's not the only thing that matters. You think about the kind of life you want your kids to have in that neighborhood. What is there a cafe within walking distance? How does it feel when you walk in? What a lot of people say to me when they buy a home is, I just knew. When I walked over the threshold, I just felt home. That intuition is a really powerful way of knowing, which traditionally hasn't been able to be included in investment. So how are people dealing with this? We think it's all about, big picture. We think change happens at the speed of trust. Investment is about trust. Do you trust that claim's been offered? Do you trust that things will happen in the way you want? That obviously the actual people are honorable? And this is, and the earlier stage, the more you have to show trust, is an inevitable element of early stage investing. So there's three main ways we think that people are trying to kind of overcome some of these barriers, either individually or by mashing these up. One is crowdfunding, providing more accessible platforms for people to go deal by deal and therefore to connect with the specific thematics, not just the idea of impact investing as a process, but a particular person doing a particular thing to make an impact in a particular place for a particular group of people, because that's the stuff that lights people up. And that allows them to experience multiple thematics, where a lot of impact investing is just one thematic deep. It's just clean tech, or it's just West Australian social enterprises, or it's just female founders. There isn't a fund for female founders of clean tech social enterprises in Western Australia, because none of the funds can go multiple layers deep because they worry they'll never find enough investments. But that's actually what resonates with humans, is often when multiple things we care about intersect in interesting ways. So caring is always intersectional. It doesn't actually exist in pure silos. The second way is investment clubs and giving circles, various mechanisms of kind of sharing deal flow amongst a specific community, perhaps with a membership definition or fee involved, or sometimes, by pooling smaller amounts of resources and then making a decision together about where that gets allocated. So there's a bunch of interesting experimentations. And of course, these don't sometimes involve technology. Sometimes they're very localized, happen in a room together, but various ways of trying to facilitate the flow of capital to more interesting early stage, excuse me, things. And the third is data sharing. So kind of infrastructure, informational infrastructure and better ways of sharing things like deal flow, existing due diligence and so on, to again reduce, help people access what they really care about, help deals happen more efficiently, capital flow faster. And people are mashing those up in interesting ways. So I've gone on long enough. I'm just going to quickly tell you about our model at Lend for Good. We're a crowdfunding platform. So as I said, people can find search by specific impact thematics or SDGs or locations to find deals that really resonate with the things they care about and want to put their capital towards. Can also search, as we improve this, you'll be able to search by minimum returns for you, rather than that being one cookie cutter template, when you might, what length of time you might be comfortable with and so on, to really drill into the things that matter to you. Now, right now, early stages, only have so many on at any one time. You may not find, if you get too many thematics deep, you might not find them, but that's the goal. But it's not pure kind of make your own judgment, buyer beware. We use a syndicated model, which you'll see with some platforms. So it's kind of in a way a mashup of the giving circle idea or even data sharing plus crowdfunding, which creates a tri-party marketplace. So obviously we're a lending platform, so there are borrowers and lenders, but what's crucial with us is we have what we call intermediary partners in the middle, and they're entrepreneur support organizations who are already in the business of identifying and supporting potential in impact enterprises, and they bring a variety of knowledge and expertise and trusted relationships where they're years ahead of us in doing due diligence, in understanding what works, in understanding what the community needs, and they can work with those enterprises to design deals that are specific. And what's great about them is they see very different patterns. We know one of the endemic challenges in investment is people are kind of pattern matching against what they've seen in the past, which is why white men get systematically overfunded in a lot of markets, because it's white men doing a lot of the decision making, but also a lot of the people who've made the money in the part of white men, and all of that just kind of reinforces often on a subconscious level because people are pattern matching. So we think we'll diversify the pattern matching, people who see different patterns. So we have, partners like Mekong Innovation Ventures who work with Khmer and Karen refugee women in Cambodia to help them start businesses, like Cricket House, which has been one of our big successes. Organizations like Whitebox in Australia, who build some of the best work integrated social enterprises, including Beacon Laundry here, who raise funds with us. Organizations like Renewables in Africa, who understand the potential of Africa to be a clean tech superpower and who supported Ehu Motors. And those who see Indigenous Australians as a source of great ingenuity and business opportunity, like Corey Gretschy, a founder of Native Botanic Brewing, which after raising funds with us, then won the KPMG Indigenous Business of the Year last year. So really keen to explore, it's enough from me, but really keen to dive further into kind of these three trends, or if you think there's slightly different trends, there's a quick QR code on the thing there if anyone wants to check out the platform, copy, photograph that and then save for later. And I'll wind down my sharing now, and we'll jump into more of the conversation piece. So, Cameron and Karen, let me see if I can just pin you. Can I add spotlight? Yep. Fantastic. Oh, there we go. And shout out to everyone else here. Please do feel free to put questions in the chat as we go. We'll keep an eye on that. Might, seek to weave those into our existing answers, or we'll come to you at some point and maybe invite you to come off mute and ask it directly, or share your own reflection. But I guess rather than me just reading a bio, I always find that a little bit something uncomfortable about that. I'd love for you guys just to kind of, do your own quick intro of, I guess, your story as an entrepreneurs, as ecosystem builders, kind of how you've interacted with impact investing and social enterprise, which for you, I know goes back a long way, Cameron. So why don't we kick off with you? And when I first met Cameron, he was this brutal truth teller in the Australian, still is, I'm sure, in the Australian social enterprise ecosystem. I feel like he was the only other person I saw who was maybe telling budding social entrepreneurs probably exactly what they were getting themselves in for, which I think is really, really helpful, because a lot of fantastical thinking in the space, much as it is obviously a huge opportunity. But you've since moved on to kind of looking more at technology and infrastructure and working globally, of course, currently based in France. So please, over to you to kind of introduce yourself more fully.
I hate doing self-introductions. I'd much rather have somebody talk
from
about
one awkward idea to another.
myself. So yeah, as Tom said, I've been an impact innovator and impact entrepreneur for coming up 30 years. I've been fortunate, like Tom, so this has been sort of my entire career. As he said, I'm currently based in France. I've been working in impact tech for over 20 years, and part of what attracted me to technology was not that I see technology as being a silver bullet, but that I see that there are so many problems that have been solved that we're actively resolving. And so the issue with the missing middle that Tom has spoken to more eloquently earlier on is something that we see that technology can actually help to address. So, I'm a systems engineer and a systems entrepreneur. And I think that the best summary that I can give on why I do things the way that I do them is that everyone's talking about systems change. But systems change is an end result. And systems change occurs as a result of systems thinking, systems design, systems engineering. And so we are focused on the systems engineering component of systems change. And when you read what it is that's being posted in the chat about what Catalyst Now's purpose is, we could easily reflect that back and say, well, our purpose is to build the enabling infrastructure that allows Catalyst Now and all of the other Catalyst Nows, all of the other networks and databases and communities to actually aggregate up their impact to address not just the $1.5 trillion or $3 trillion that's looking to be invested, but the $200 trillion funding gap that currently exists to successfully address the Sustainable Development Goals.
You're on mute, Tom.
That's embarrassing. Thanks for doing that. So what I was saying was, could you just flesh out for others, kind of who, again, would definitely resonate with, yep, we need better infrastructure for that and so on. But what is the actual kind of piece of that puzzle that Amalaria is kind of trying to fill in, and how do you do that?
Yeah, so the objective for us is, so if you recognize that there's a $200 trillion funding gap, then you also will recognize that it's mathematically and morally indefensible to try to solve multi-trillion-dollar problems, one project, one investment, one fund at a time. Like the current approach to solving wicked problems is mathematically indefensible. So we believe that, we are not huge proponents of Web3 and AI, even though they're transformative technologies. We recognize that there are millions of individuals and organizations out there that are currently working to address the SDGs, but there is no cumulative impact that's possible because there's no coordination mechanism possible. So when you talk about things like the deal sizes are too small for impact investors, part of the challenge is that no one has actually aggregated the demand side of the capital market for impact finance writ large, whether that's development funding or philanthropy or traditional investment, et cetera. And so what we're really interested in is aggregating the demand side of the capital market so that then we're able to help to create new capital products that investors can put their money into and get the money out of being the ones who are making the decisions about what matters. Because to us, that's a critical problem with the way in which things are funded in this space. So, we are focused. We do have a platform called the Innovation Exchange. We acquired another platform, a crisis tech platform called Needs List. We've currently integrated those two things together. And we look at partnering with organizations like Lend for Good as an example, so that we can off-ramp innovators from our platform if they're looking for debt capital onto Lend for Good, and then off-ramp from Lend to Good back into the Innovation Exchange so that those successful borrowers can potentially find other forms of finance. So that's very much, we see every platform as being a potential collaborator rather than a competitor. You're muted again, Tom.
What is wrong with me? You'd think this is the first Zoom I've ever bloody hosted. Sorry guys, not my sharpest tonight. Still in WA time. Don't actually, that would probably not only have me be more awake mid-afternoon. So Karen, interested to hear your take on things. I mean, you've been building a social enterprise movement, a consumer movement with our kinds. You've raised different amounts of capital yourself. You've been up against some of these gaps. You're simultaneously, and I'm really keen to, for you to tell more for anyone who's not familiar with Coralus, the community of women funding women that you're part of, and I do think I think it's so fabulous that you are, you know, both building your, you know, there's one of the dangers, I guess, with how annoyingly hard this fundraising is in general, is that it does make people more kind of more self-focused, monomaniacal, you know, trying to find yours, more competitive as we you know as we try and access scarce funding. And I love that you've been kind of simultaneously on your own founder journey, but also giving back to the community, helping build that network. So yeah, would love you to kind of tell people about both of those initiatives, how they weave together, you know.
Okay,
Your
very
impact
happy
investing
to.
experience.
Thanks, Tom. So my background is actually in connecting people. I've worked in experiential marketing for probably most of my career as a major event producer, working with corporates and brands, etc., around behavior change and including like how you perceive something, you know, and how much you want it, how much you're prepared to pay for it, all that sort of thing as well. Through my career, I have, as a kind of an entrepreneur, identified gaps in businesses and often been able to just kind of retire stuff that was no longer necessary through just ignoring it and allowing it to become redundant. And then kind of at the same time, identifying where there's some new gaps, whether that's for revenue streams or a greater reach in terms of being able to develop, extend your services, etc., and attract new revenue. So I have worked in agency and in corporate and in government, and what I found about 6 or 7 years ago is that patchwork of a career was perfect to be a founder of a startup, because you actually get a real sense of how all the different pillars of the business work. And also, I've been lucky in my career to understand how decisions are made at very senior levels, because in the work that I did in major event production, I was often dealing with the C-suite. So I saw how fast decisions could be if you had the right information there. I found the same thing. You described it so beautifully, Tom, in that there is money around there at the start. Like when we start, our kinds started as a absolutely commercial startup, but with absolute social impact outcomes. And our first goal was to eliminate single-use cups. And we attracted nearly $500,000 in our first 4 months. And that was from high net worth individuals who were very interested in seeing us solve this problem and could see that we were solving it from the coalface up, but also that we had the right team to kind of really be able to develop a concept and be able to deliver on different areas of that concept, and tell stories about it. And we also got out of the starting blocks really quickly with revenue. So we got subscriptions and we got sponsorship. And we fortunately didn't take government grants at that time, because we felt like they would be too unwieldy, expensive to deliver on, as you mentioned, Tom. But also, I've written lots of emails to government when they've recommended some grants for us to say, we don't want to share your risk. You know, so a lot of the grants expect a founder who's already put everything they've got into something to, you know, put up 50% up the front to prove again that they can do something. So we actually found ourselves in a really heavy reporting cycle, not with our investors who give us a lot of freedom, but with the subscribers, etc., that we had. So we actually stopped taking revenue. And we've just been working away with sort of bootstrapping, sweat equity, and a bit of sponsorship, etc. We're just about to relaunch, and we're in relaunching. Our vision is actually, we've created an operating system as well, Cameron, but it's actually people powered, where we've identified all the problems in the supply chain, and we're activating the supply chain to enable this transition. So that's our kind of as a a startup, this is my second startup. In the first one, I was brought in as CEO after a startup had been running for about 5 years. I invested in that myself, so am an angel investor. I've also invested in giving groups over the years. So I am familiar with that side of it as well. Through Our Kinds, I actually had someone following me, a woman called Marianne Anderson, who really engaged with my post and started sharing them, etc. And she got in touch with me and said, Karen, I think you would be good for Corylus and Corylus would be good for you. What I discovered was that Corylus is a group of less than 1,000 women who've raised a $10 million fund over the last 15 years. And that fund has had 21 million in impact in terms of no interest loans going out to founders, often being repaid earlier than the 3 years in which they're scheduled to, with very little due diligence, just really built through becoming much more aware of that startup and what that startup is trying to achieve, and then providing what you find in Corylus is it's way more than money. There's incredibly skilled and high level women in there. I've just been at a conference in Canada, and like the VP of the Toronto Stock Exchange, there were women from the capital markets in New York, also mystics, people who are very spiritual, etc., working in startup spaces there as well as all of your sort of usual advisory. Corylus is now rethinking. We're going through a transformation at the moment, how they deliver capital to founders acting on the UN goals. And what they've absolutely considered is it's better together. And so we're looking at how we fund multiple startups at once that are working together to solve a problem. One of the great ways in which Corylus works as well is that you can come in as a finalist or you can apply for the funds, for the no interest loans. The community gets to see those applications. What often happens is that the people who don't get through, or even the people that do get through, will often have angel investors from the community will come in and offer in money. So you've got that kind of growth there. And I just want to touch base on one more thing, Tom, before I stop rambling on, is the connection between a gap that the UNDP have identified and crowdsourced fundraising. So I was at a UNDP discussion forum last year, and they'd seen that you needed 1% of global wealth to come across to really address the UN Sustainability Development Goals. They were developing a scaler for Southeast Asian startups that were addressing the goals. What they needed to attract, they found what they needed to attract from impact investors was startups that understood consumer drivers and could not so much even report on those, but be able to tell stories about those. So what the thing that just keeps coming back to me, and it's probably because we're absolutely on the ground every day supporting a change that is related to an everyday habit for consumers. And it's obvious, we can influence someone to choose a reusable cup instead of a single-use cup, with Our Kinds. And so therefore you can get photography, you can get video, you can get data in scanning cups, all that sort of stuff. So the impact investments, the base or the traditional investors are saying if they're going to take reduced returns, they want to kind of alleviate some risk, and some of that is brand risk, by being able to prove that they're investing in things that can demonstrate shifts and can demonstrate this shift kind of daily. And that is a gap. Yeah. But it's a gap that the CSF platforms address. The other thing is that as you said, with the venture
CSS,
capital,
crowdsourced funding,
etc., you've got to do a different due diligence for everyone. But with the crowdsourced funding, you've got one source of truth. So, you know, when I ran a crowdsourced fundraise for Kidness, the previous startup I was involved with, you have one alpha document and you attract 138 investors. That's what we did with
I'm interested in your
$268,000.
take on this, Cameron. I think we, super inspired by crowdfunding, obviously, and I, have a big background in it. Launched one of the first social purpose crowdfunding platforms in Australia and the region. When we first launched startsomegood.com back then, we required everyone to make a video. We'd studied that campaigns with a video do better than those without. And part of why we said that to people is that you have to prove you are who you say you are. There's something, it's kind of like being on a video, like, hey, I'm Tom, and it's like just more to it than a photo and a thing and text. But I feel like with AI, that there is an increasing ability to spoof all sorts of things, and that video is no longer enough. And so we thought a lot about, we think there's this kind of piece around, verification by some sort of third party, in our case, intermediaries. I think in your case, there's different mechanisms, Cameron. But in order to get beyond, personal networks with whom you've built individual trusts and the time and investment by all concerned with that. And that can be enough because, what we often see with crowdfunding is someone trusts you and they share it. And so I see it and I trust their judgment. They wouldn't back Karen if Karen wasn't reputable because Cameron says she's his friend. But I know Cameron. So it is those kind of chains but we want to bring in, I guess, those intermediary partners as part of that. I'm interested in your thoughts, I guess, Karen, about that opportunity, but also kind of how we give people not just access but confidence, I guess, in terms of what's been presented, the stories, the data, the verification. As you said, Karen,
So
verified it.
I'll answer that question in a slightly roundabout way.
All right, go.
From our perspective at Armalaria, like one of the principal challenges that we see is that there is a $200 trillion funding gap. And if you start from first principles, then you have to think about how do we solve a $200 trillion funding gap, right? You can't start from how do we address funding for women or for Indigenous peoples, et cetera, right? Like if you're starting from there, then you are immediately siloed. And so it doesn't mean that like those funds and those networks aren't important. They're incredibly important. But part of the challenge is that like none of these funds and networks are entrepreneur-centric. And by that, I mean that like if anyone who's on this call, including both Karen and I and you, Tom, have tried to raise money, I'm sure that you have lost count of the number of platforms and number of forms that you had to go to join, fill out the same information, copy and paste from a Google Doc over and over and over and over and over again, right? Like the biggest challenge that I see in impact finance is that those organizations that have precious little time and money spend a lot of time and money chasing organizations that have a surplus of both. So you said earlier on that like the impact finance ecosystem is funder-centric, and that is absolutely true. So from our perspective, when we look at an organization like Coralus as an example, or any fund or foundation, like the Gates Foundation, our intention is to be the front door through which every single submission runs. And the reason for that is that we want the entrepreneur to own their data. We want to make it easy for the entrepreneur to say, well, we're going to submit to Coralus, or we're going to submit to the Gates Foundation, and we're going to be able to create a variant of our submission and then resubmit it to another opportunity later on. Because every time you lose control of your data, basically what's happening is someone's punching their information in someone's form, and that data then goes and dies in a data grave somewhere, never to see the light of day again. Our interest is in mobilizing all of that existing information. So when I think about a fund like Coralus, and I'm talking out of my hat here because I don't have an understanding of how your infrastructure works. Part of what we see the opportunity as being is like, well, not only like how do we ensure that the information that flows into that network is valid for that network, right? So that they're not looking at things that don't meet their investment thesis, but how do we ensure that all of those potential investments that they said no to wind up resurfacing back out into the marketplace rather than just disappearing into a database. So to us, like that's a critical challenge. But then when it comes to trust is absolutely transferable. And so, again, using Coralus as an example, if Coralus has done due diligence on a deal, and let's say that they've invested in it, right? Well, that's a badge, right? Like Coralus invested enough, that is a badge. So I can see that Corliss has done due diligence, but also why can't the due diligence that's being done be shared, right? So let's say that Corliss does due diligence and says, no, we're not investing in this in this particular opportunity. Great, let's surface that diligence and make it available to the next potential funder so that they don't have to burn time and money doing diligence again. Like all of this is possible, right? So one of the things that you talked about, Tom, was like in the three things, data was at the end. That is the space that we live in. We are all about mobilizing knowledge, innovations, and capital at multi-trillion-dollar scale. And the only way that you can do that is through effective use of data. That being said, you can't, like, this idea that AI is going to magically solve this problem, quite frankly, it's bullshit. Like there are petabytes of unstructured data buried in proprietary databases and data graves that nobody has access to. So you can train AI, you can only train AI on data it can see. And most of the data and the impact space is completely invisible. So if you go to, say, ChatGPT or any of these other large LLMs, you can get great answers to questions about visible data. But if you were to ask it a question about who are the top 10 funders who are focusing on making investments in water and sanitation in East Africa, it's just going to shrug. It doesn't know because all of that information is buried somewhere. And so for us, like we're really focused on, how do you mobilize this information in such a way that, you know, not only does the data become more usable, but to your point, trust becomes transferable because so much diligence is being done, right? Like every organization has been sniffed at and invested in and funded and done varying degrees of due diligence. But if it comes down to me having to say Karen's ace and Tom says, well, Karen's ace, and then, Karen gets funding from someone, that is not scalable at like the speed and scale that we have to mobilize capital. We have to mobilize close to 50% of available capital in the world to address the SDGs. There's $450 trillion of capital. We need 200 trillion of that to address the SDGs. It's never going to happen the way that we're currently going about it. Sorry, here end of the rant.
No, spot on. I mean, I think that whole piece around due diligence is exactly right. I mean, such a big part of what we thought about, but what we've seen is that when people set up kind of crowdfunding type experiences, and it will never be enough on its own, but I think kind of particularly in that earlier stage, allowing small family offices and individuals to build portfolio and get involved can be so powerful. But particularly at that early stage, it's just there's no way. So essentially, there's two ways to do it. One is buyer beware. You just upload everything yourself. We're not looking, we're not vetting it, which is what most crowdfunding. You read it with your own ability to pass the information, etc. Your own relationships. The second is that there are some that are basically managed funds masquerading as crowdfunding platforms, but kind of there's a single organization doing all the due diligence, and you're often actually investing into some sort of trust, maybe not direct, but it kind of lets you curate project by project, so that can be satisfying. And then the third is these syndication models. So we were kind of inspired by AngelList in the US, or Aussie Angels here, which is a similar idea, I think, which is a lot of people are interested. AngelList's kind of an original insight was that there's lots of people who kind of were willing to take the risks. In fact, they were hungry for it, of being an angel investor with all the kind of cachet and hype around that, particularly at a certain stage. But access to deal flow was incredibly uneven and very limited. If you lived in Nebraska, you could have all the money in the world and be a sophisticated investor and people, but what are the chances that you're going to meet the right startup founder who's going to bring you their deal at the right time? So instead, you could say, here's a guy in San Francisco who has a good track record, and I more or less trust his due diligence process, whatever that is. It's often beers in the pub and so on, getting to know people, but that's fine. I'm going to follow them into deals. And we think there's something really interesting about that kind of when you can combine that choice, you still get to kind of, you don't have to follow them into deals. It's not like a fund where you're kind of committed up front and whatever they choose, you're in, whether you like it or not. But that choice of following based on some existing piece of due diligence, because that's exactly right. Due diligence is like food. There's heaps of it, but there's also lots of hunger, and it's because it's often wasted and poorly distributed. I think that's exactly right. But it's kind of unlocking that, I think, kind of that makes it that access piece, I think, is also. The scale is overwhelming, but I don't see how we're going to have enough bigger deals if we don't also have smaller deals, even if the smaller deals will never add up. It's got to kind of build that pipeline, obviously.
But I think the smaller deals, sorry to jump in, but I think the smaller deals can add up. And one of the challenges that we see, and where I think AI can be incredibly helpful, is that there are deals all over the world, but with English being the unofficial language of the internet, right? Like most of these platforms, and ours is currently guilty of this, which is part of the reason why we're bringing in AI specifically for translation, is that you should be able to submit information in your language of choice and consume information in your language of choice. So most of the large networks and funds and communities only receive submissions in English. And that's a real problem, right? Like I saw a UNDP funding thing that came out recently. It was like, all submissions must be in English. And it was focused on food security in frontier and emerging markets. Like, how is that defensible to say that you want to receive submissions in English when the market that you're here to serve, most of them, English is not their first language, if even their second.
That is disappointing. I mean, they're the pioneers in instantaneous multi-language conferences and so on. I mean,
right.
So yeah, I'm interested in your thoughts, Karen, I guess, about what you see with Corrolus, especially the step after, in terms of what you've observed so far, as we talk about this kind of, I guess, small into big, because I think that is I think it might take a few stepping stones at different stages, but you're kind of coming in relatively early, as I understand, and obviously providing a very friendly type of capital, no interest, loan and so on. What do you see happens next? Do they tend to then make the jump to kind of professional impact investors or equity investors, or do they need other types of philanthropic support, or what have you observed so far? Or do they get stuck, kind of unable to find that next piece?
There's enormous interest in removing due diligence and making decisions based on trust. So it's probably about as far as you can get from moving into that more, I suppose, I'd say sophisticated, but I don't think that's the right word, because what is happening within Corrolus is quite sophisticated.
I hate that word, because they're often really naive about impact and the state of the world. They're not sophisticated at all. They just know.
I know.
That's one of those mental models and framings, I feel like, or processes. But the rest of us are unsophisticated and rich people are sophisticated.
It's not linear.
It's a term of art in Australia, just for everyone else. Yeah.
It's actually about I can never say the word. Reciprocity is at the core of it all, right? And so, it is about being in relationship. And there are all sorts of ways in which in this, fund that you can be in relationship with others. And then those relationships become a bit of a spider's web, right? Now that does kick out into venture capital, and it kicks out into more angel investment and into crowdsourced fundraising. So for example, Pleasant State were, the women in Pleasant State, Amy and Sian, were activators in Corrolus. They then ran a successful crowd fundraise, and they brought the Corrolus crowd plus all the people that follow them with them, so and I think that when you go into a crowd fundraise, the advice is always build all your followers, build knowledge of your story and whatever, and then you go in and you explode that. Now, sophisticated investors, as in the literal term that they use, or ultra high net worth, etc., they're looking at this, and they're taking, when I'm briefing investors for when we do a crowd fundraise, we're not going after venture capital at the moment. The term is, we would probably put in between 5,000 to 20,000 at the moment to get a footprint. It's not about managing risk now. It's about making sure that if we're the next Canva, they can participate in the next round in case that next, step up of a $5 million crowd fundraise runs out in one day, which is possible, right? And they could miss out. So the big end of town is in there, but it's in there in a small way. Then the flip side of that is that they're growing first-time investors amongst women and very diverse communities, because the entry point is so low, but there's money sitting behind those people as well. And women make 80% of purchasing decisions. And in fact, our kinds is mostly women funded. But if you looked on the share registries, you wouldn't know that, because it's generally the male whose name is holding the admin
Oh,
for that
interesting.
superannuation fund or whatever. So you're right, Cameron, there's a whole lot of information out there that's not representing the market accurately. So I truly believe that, you know, it's about awareness mostly. It's about getting your story out there. It's about building trust. It's about always showing up. And then it's about being agile and looking for partnerships as well that are aligned with what you're doing, where you're giving forms of value and with partners that can be brands that will also attract those, you know, angels and VC, etc. So it's
Yeah,
not
I
a
love the idea of
one-stop
angel
shop.
investing as due diligence, as cheap due diligence. I've tried to pitch that to some bigger funds. They haven't really picked up on it yet, but at some point I'm hoping they get it. That if you're spending $50,000 on due diligence, well, I mean, put $25,000 in, you'll get $25,000 at least worth of information and insight. And, you know, by the time the next round comes around, it'll probably cost you less than $25,000 at that point to do the due diligence, and voila, you've, you know, kind of got a better situation as well as more upside. I just
Exactly.
realized the
And
time is just absolutely flowing. We're already past 7 here in Sydney. I'm afraid I didn't actually throw. I mean, there were no questions in the chat, but apologies if anyone does. I don't know if you guys have to jump off immediately, but I'd love to give people like just a really rapid fire. We'll have to keep it pretty rapid fire because I also have some family
I'm good
responsibilities.
to keep going.
Unless there's another session kicking off on this same Zoom room, unless people are just arriving, Jill, are they here for like the next session, or are they just really late for ours?
No, I think people just bouncing in and out, but
okay. Yeah, probably connection. So does, you know, if there aren't any that we don't have to worry about, I did want to like actually officially pause and you know, invite anyone on the line who does have a question for any or all of us. So if all of us, we have to keep it particularly short.
while we wait, Tom, can I just share a learning from Crowdfund
Yes,
Raise?
please.
If there's anyone on here thinking about doing one of the things I learned when I did a virtual raise earlier was to ring through everyone that goes into that expression of interest stage, because people will go in there and they'll put an expression of interest of $250 or something like that, or potentially up to 100,000, whatever. As I rang through from one investor, I actually got a referral to another investor who then dropped in $68,000, like after a conversation. I also had one investor who, in the expression of interest, you know, said had put in 10,000. Once I had a chat with him, it became 25,000. He then became an advisor, and then he took on sweat equity, and they follow on. So that $68,000 investor became a $200,000 investor and followed me into the next startup.
That's cool.
So, you know, just a huge recommendation to communicate, share your story.
I'd love to add something as well. I'm still waiting
please.
to see if any questions roll through. So we've only raised a very small amount of money. I've been an entrepreneur in the space, as I said, for 30 years, and I've always been profit driven and have always built things and sell them, right? So from my perspective, like, if somebody wants what you have, they'll give you money for it. If they don't want what you have, then they won't give you money for it. So like, put something into the market, see if someone's going to give you money for it. If they won't, then, you know, do something different. We raised only a couple of $100,000 at the end of beginning of this year, I should say, at the end of Q1. And we were we've always been very clear, or I've always been very clear, that I don't want the money making decisions about what I do with my company. So every time I show up to a conversation with a prospective funder, essentially what I'm saying to them is, look, I'm talking to you because the thing that you've got that I want is money. That's it. There are a lot of you out there. I don't really want your ideas about how to do what I'm doing better or differently, because if you knew how to do what it is that we're doing, you'd be doing it and we wouldn't need to exist. So like, this is a conversation about money. And if you're not interested in what we're doing, then it's a very short conversation. Like, I think that a lot of entrepreneurs are very apologetic, and I say use entrepreneur loosely, it doesn't have to be profit driven, right? But are very apologetic about raising money, and sort of kowtow or bow down before the money, as if like the money has some wisdom that they don't have. With the capital that we raise, we put, it's a capped return of 1.5x, so 200,000 in, 300,000 out. It's redeemable equity, so they bought in at 5%. When we pay them back, they drop down to 1%. We don't start paying them for 18 months, and then we're repaying that redeemable equity at 3% of top line revenue. Like that is a deal that we structured. The investor was very happy with it because they are impact focused and they are also returns focused. But we took control of that conversation. We set the terms. And it's one of the things I admire about Lend for Good, right? Like Lend for Good allows the borrower to set the terms. And I think that like we have to be, as entrepreneurs, we've got to be much more comfortable having direct conversations with funders about what our needs are. And, I mean, if you're a sales organization, we live and die on, like we die on maybes. So if you're raising capital, your maybes are killing you. So get to yes, get to no, just be clear about what it is that you want and drive for, closing means closing a door, right? Like it's either closing it behind them because they've walked in or it's closing it in front of them because they don't want to, but closing matters.
I love that. I feel like I was very fortunate that my first job out of university was selling ads in a magazine, and didn't have a great boss, but that was something they said to me that really stuck with me, that my job was to get answers, yeses, nos, just answers. And if I just focus, don't get bummed out about the no's, it's an answer. That's actually a win. Yeah, maybes are the worst. And so, yeah, I've kept that with me in all my fundraising activities since, which has been very helpful. So we are solidly past time now. I think we will have to wrap up. I'll have to go feed the kids. I can quickly answer the question that's, even though it's directed to you, I shouldn't. That's kind of, I'm about to mansplain your crowdfunding campaign, but you did say it was on Birchall. So just to highlight what you've already said, which is an Australian equity crowdfunding platform. So, and Lend for Good for debt, obviously. But yeah, as a final thought, I think that's exactly what we need more of in the marketplace, Cameron. I think that if impact investment is to mean anything, it should start with what are the impacts you're trying to support and how are we then going to scale and support those impacts. And if as a result of that, asking those questions and that examination, you can also earn a commercial rate of return, well, fantastic. That's obviously a really great model at a really good stage, and well done you. But the idea that those are the only kinds of deals that will kind of solve all our problems, that we're somehow, is just the ultimate kind of using them as tools kind of concept of not rethinking the actual kind of role of capital and rebalancing the returns, which fundamentally is, I think, what we're trying to do writ large as an entire economy is, in fact, as an entire impact economy, or this new, more sustainable economy we're building, has to be one that rebalances between current generations and future generations, between capital owners and community and workers and so on. And so, yeah, we love that on Lend for Good, you see a variety of different returns, risk profiles, and all of them kind of designed to be contextual and specific for that enterprise at their stage. And that may or may not be the kind of deal that you want to put in with, just as with equity crowdfunding, may or may not be the kind of thing you care about or are willing to risk your funds on, but it may be, and it gives you that opportunity. So definitely would encourage everyone to obviously check that out and think about that, at least in the mix. And let's all keep talking however we do that. I think, look, all of us up on LinkedIn, I think all three of us share thoughts and experiences along this entrepreneurial journey regularly. So I'd love to continue to talk with everyone there and at future events. And thank you, Jill, and Catalyst Now Network for organising Catalyzing Change Week, and for building this network and bringing us together.
No, thank you. I think we have one hand raised if we want to.
We do. Okay, should we quickly take that? Yeah.
Quickly, yeah.
Wambi. Sorry if I'm saying that, completely butchering that.
It's one boy. You can think about one boy. Makes it easier.
All right. One boy. Yeah.
So first, thank you so much. This has been really, really eye-opening. I just thought to raise my hand because I have put a question on the chat for Karen. And I may have missed this in your talk, but you talk about the crowdfunding. So I'm very curious, where are you crowdfunding off? You did mention about investors or funders indicating an interest. We've done crowdfunding at TWIFund. I had done a bit of an introduction. TWIFund is a for-profit intermediary. We are based in Kenya and Rwanda, and we work at the grassroots. So we create consortiums within our grassroots to just attract larger funding and to help our grassroots organizations scale well as build capacity. So we have done crowdfunding, and it's very interesting listening to you because we've also really grown organically, bootstrapping, not getting debt, so we don't have debt. And now crowdfunding is one of those. I'm very curious and really quite interested in that platform because I don't think it's GoFundMe, so just yeah. So if you could just speak into that, please. Thank you.
It is virtual.
Which platforms have you used?
I've actually used Birchal for an equity crowdfund raise. I've used GoFundMe as a little trial. I think there's lots of different platforms out there. There's some that are specifically for women. And if you'd like to connect with me on LinkedIn, I'm happy to share some on there as well. So for everyone, so you can look at what
you will find
is best
when
aligned.
Yeah, we will need to wrap up. But what you'll find is that equity platforms are specific to countries from a specific jurisdiction because they have to be tied into the equity funding laws of that country. So hence there's restriction, Birchal's only for Australian companies. It has specific linkages to Australian taxpayers and how much money they're able to invest through crowdfunding sources in a given year. So that is a particular dynamic with equity. But look, I'll reach out to you as well because this is, Lend for Good. We work with people like you who are providing that. And one of the things that's useful about debt is it's less jurisdictional. It tends to operate very similarly under very similar contract law conditions in most places.
Okay, great. Thank you. I have sent the 3 of you requests on LinkedIn, so be sure to connect. My name doesn't change. Thank you very much.
That's nicely done. Jill, I think you're muted now, but you wanted to say a few final words to take us out or share a couple of final slides and thank you.
Sure. Quickly. Yeah, sure. So thank you all for coming. Please do share on social media. You're welcome to tag us. You're welcome to tag your speakers. Share your biggest messages and circulate, this amazing thing. We will be sharing a recording of this on YouTube in the coming weeks, so you'll be able to rewatch. And please reach out to your speakers, and thank you for joining.
Thanks so much, everyone. Thanks for having us, Jill and Catalyst Now team, and thank you for joining us, everyone.
Thanks all.